Hey everybody, this is Dr. Tom Carr, aka Dr. Stoxx. Welcome to the Dr. Stoxx Options 101 webinar. In this brief webinar, I'm going to be introducing you to the trading of the trading of options on stocks, indexes, and exchange-traded funds. Just a very basic introduction. And I'm also going to introduce you to the new Dr. Stoxx Options Letter. We're going to be doing three things in this brief webinar. First, I'm going to introduce you to some of the basic terminology of options. It's a little different from the way we describe how we trade stocks. And if you're familiar with options trading, you can probably fast forward through all of that. That's really not going to be anything new for you. If you're new to options trading, I do encourage you to work your way through it and go back over anything that is a little bit unclear to you. Make sure you have those terms down, because we'll be using those terms as we go through the webinar and also as we trade the positions in the Dr. Stoxx Options Letter. And then secondly, I'm going to introduce you to the three types of option trades that we put on in the options letter. Just want to make sure you're familiar with these three very basic strategies, three very profitable strategies, but they're very different. They each have their own risk and reward profile, and I want to make sure that you're familiar with those so you kind of know where you would want to focus your trading efforts. And then thirdly, I'm going to take you over to the trading platform that I use in Interactive Brokers to actually put on option trades, and I'm going to show you what that looks like and how you go about putting on, for example, a naked put or a vertical credit spread. So we'll do that at the end of today's webinar. So let's get started. First, some basic terms. A call option, as maybe you already know, is the right to buy a stock, exchange traded fund, or index, and that stock, ETF, or index is called the underlying at a specified price, and that price is called the strike price. You can buy calls or you can sell them short, just like you do with stocks. If you buy calls, you have the right to buy the stock at that specified strike price on the date of expiration, and we'll talk about that in just a moment. If you short calls, however, you have the right to short the stock at that price on the expiration date. Calls will generally rise in price as the underlying rises in price, and one call is equal to 100 shares of stock, which means that they're a very leveraged instrument. So for example, if you like Apple stock, it's trading, I don't know, around 107 or so right now. If you like Apple stock and you think it's going to continue to go up, you could buy 100 shares of Apple stock, which would cost you, what, $10,700, right? If it's trading at 107, I'm not exactly sure where it is right now. Or you could buy one call option, and a typical call option with, say, 2 to 3 months of expiration time ahead of it, that would be trading around at the money or maybe a little bit out of the money. You would probably go for about $3 or $4, which would say times 100 shares, that would be $300 to $400. Maybe a bit more than that, depending on the volatility of the underlying. So you can see that for $300 or $400, buying the option, the call option, you are actually in control of 100 shares of Apple stock. So it's much less of a cash outlay, and that makes option trading a very, very attractive form of trading for those with smaller trading accounts. Now, a put option is just the opposite of a call option. It gives you the right to sell a stock, ETF, or index, called the underlying, at a specified strike price. And just like calls, you can buy puts or you can sell them short. Now, if you buy puts, you have the right to short the stock at that strike price on the date of expiration. If you short puts, and that's a strategy we'll be doing quite a bit of, you have the right to buy the stock at a strike price on the date of expiration. Puts will generally rise in price as the underlying falls in price. So buying a put is very much like shorting a stock, only you're doing it with a very leveraged sort of instrument. And like calls, one put equals 100 shares of stock. The premium is the price that you pay to buy at the ask or short at the bid an option. So when you're buying an option or selling it short, you're dishing out some money. And that money is the premium. It's how much the call is actually worth at that given moment of time. Calls and puts trade just like stocks with both a bid and an ask. You buy at the ask, you sell at the bid. Now, in many cases, and I recommend this strongly, you'll put your order price between the bid and the ask, because sometimes the spreads are quite wide, particularly if the option is not well traded. And so you'd put your limit order right between the bid and the ask, and you often will get a better price than the ask if you're buying, or better than the bid if you're selling. The amount is debited from your account when you buy an option and credited to your account when you sell an option, and that's just like the buying and selling of shares of stock. Now, options come in three varieties here: in the money, out of the money, and at the money. And these three types of options are designated by where the current trading price of the underlying is relative to the strike price of the option that you're buying. So, for example, an in-the-money option is one in which the strike price is below, for calls, or above, for puts, the current price of the underlying. An out-of-the-money option is one in which the strike price is above, for calls, or below, for puts, the current price of the underlying. And an at-the-money option then is one in which the strike price is roughly equal to the current price of the underlying. This following slide just gives you a brief look at those three types of calls and puts: in the money, at the money, and out of the money. An at the money option is fairly rare because, of course, 1 penny above or below the strike price of the underlying will make it either in the money or out of the money. You have to be right on the penny to be exactly at the money. But sometimes we'll use the term at the money to describe an option that's trading very near the strike price. Apple calls and puts generally are designated in $1 increments, and sometimes you'll see them even in 50-cent increments. And so if you have a say $107 call option, and if Apple is trading right at 107.00, we'd call that an at the money call option. If Apple is trading at 106, then the 107 call option is out of the money. If Apple is trading at 108, then the 107 call option is in the money. If the Apple is trading at, say, 107.10 or 107.12 or even 106.88, we'd likely still call that an at the money call option. A few more basic terms here and then we're done. Expiration is the date at which an option can no longer be traded and the rights of the option holder expire. So if you have a call option that expires on the date of expiration, if you are in the money, you have an obligation then to buy the shares of the stock. If your call option expires out of the money, however, you simply the option expires worthless, and you simply lose the amount of premium that you paid for that option. If you hold an out of the money or an exactly at the money option at expiration, it expires worthless, and again, you lose the premium that you paid. But an in the money option at expiration forces you to buy 100 shares of the underlying at the strike price for each call that you bought or each put that you sold short. It also requires you to sell short 100 shares for each put that you bought or each call that you sold short. So expiration date is something to keep very much in mind. Now, normally in the way we trade options, the way I trade options, we will be holding our calls and puts all the way to expiration with the expectation that they will expire worthless. And I'll tell you in a little bit why that can make us a lot of money. If we're buying calls and puts, straightforward calls and puts with the expectation that the underlying would rise if we bought calls, the underlying would fall if we bought puts, then we will not, in most cases, we will not hold them to expiration. We will simply trade them within the date of activity of trading and not hold them to expiration. So more on that in a little bit. The time value and time value decay, these are two concepts that we really need to get a hold of when we're trading options, because this is very different from trading stocks. Everything we've set up to this point is pretty close to what it's like to trade a stock, only you're using a lot more leverage. This is a very different thing here. This really marks options as being a different kind of trading vehicle than stocks. Time value is added to the premium of a call or put as an extra cost or a credit if you're selling the call or put short of the put or call. Time value increases the further away the option is from expiration. So the time value of an option, a call option that is 3 months away from its expiration date is going to be a lot more than that same call option at the same strike price that's only 1 month away from expiration or only 1 week away from expiration. So the closer you get to expiration, the smaller the time value becomes. So if you're holding an option, a call option or a put option, over a long period of time, even if the stock goes nowhere, you're going to see your call or put option decrease in value because that time value is slipping away from you. So time value decreases, and usually the word that's used here is decays. Time value decays the closer it is to expiration. Time value decay, and I'm going to throw a term on here I don't have in the PowerPoint, theta decay. Theta is a Greek letter that's sometimes used to describe this particular phenomenon of options. Time value decay or theta decay occurs regardless of what the underlying does over time. This is very important to understand. The rate of the time value decay increases. It's an exponential increase the closer one gets to expiration. Let me say that again. The rate of the time value decay or theta decay increases the closer one gets to expiration. Let me show you what this looks like in the following chart. So let's say we have a call option that we bought 4 months out from expiration, 120 days from expiration. In that first month that we hold the call option, we're going to insert some numbers here. The time value over that first month would have decreased about 5%. The time value over the second month, 90 days out to 60 days out, is going to be about double that, about 10% gone. So the first 2 months of our holding that that call option, 15% of our time value has disappeared. Over the third month that we're holding this option, from 60 days down to 30 days until expiration, we're going to lose double what we lost in the second month, which is about 20%. So now we're up to about a 35% loss in the time value, but that means that 65% of the time value is still packed into the premium of that option. And all of that, all 65% of that time value has to decay. It has to dwindle up to the day of expiration. So in that last 30 days of expiration, we're going to see 65% of the time value that we saw 4 months ago completely deteriorate. And it actually increases in the last week really sharply. You're going to see decreases every single day that you're holding the option. Decreases of even up to 10%, 15% per day in the time value of the option. Now, this is a concern if you have bought a put or call and you're holding it close to expiration. Unless that put or call is very strongly in the money, you're going to see any profits you may have in the put or call disappear completely. But we can harness the power of that theta decay, that time value decay, by selling puts and calls, particularly puts and calls in the last week of their trading, especially in the last month, but even more so in the last week of trading. We want to sell short puts and calls in that last week of trading and watch that time value disappear in our out-of-the-money puts and calls, and that's a very good way to make instant income in options trading. That's one of the two of the strategies that we use in this letter. Focus very much on what we call theta decay or time value decay. So let's talk briefly now about the 3 strategies that we use in the Dr. Stoxx Options Letter. Now, the old-time standard strategy that everybody who's traded options has done this at some point in their options career, and I certainly do a lot of it myself. And that is to just buy a call on a stock you think is going to go up, or buy a put on a stock that you think is going to go down. And we also do a lot of this on the exchange traded funds as well. This strategy is best to use when you are very bullish, which is when you want to buy calls, of course, or very bearish, which is when you buy puts, the stock or ETF. And I have to emphasize this, over the short term. You are very bullish over the short term. You are very bearish over the short term. Why? Because of that time value decay. So we want to see a stock that's going to move quickly and strongly in the direction that we anticipate it is going to move in without much delay. Because the longer we hold on to that call or put, the more our time value begins to slip away from us, and that means our profit is going out the window. So for all those reasons, buying a put or call on a stock or ETF carries a high level of risk. This is the highest level of risk when trading options, but also a high level of reward. This is the most leveraged way to trade options, buying a straightforward call or put. So we do a lot of this in the Dr. Stoxx Options Letter, but I want to make everyone aware that our win ratio for this particular kind of strategy is not nearly as high as the other two strategies that we'll be using. But our wins on a percentage basis are huge, right? So that's the reward. An important thing to note is that the time value decay is our real enemy in these kinds of trades, and we really need to see strong price movement over the short term. Otherwise, the trade is not going to work. So our second strategy, and one that has less of a risk, is what I call the naked put covered call cycle. This cycle, or this strategy, is best to use when we're modestly bullish a particular stock. We do not use this cycle when we're bearish a stock. We just avoid stocks that we think are going to go down altogether with this strategy. We're only looking for stocks that we think are going to go up. This strategy carries a medium level of risk and a medium level of reward. And it works like this. There are several steps to this cycle. The first thing we do is we find a stock that we would like to own, a stock we would like to have shares of, a stock that we really believe in. We know the company well. We understand the product. We really think it's a great buy. We think it's undervalued. We think its strong growth potential is off the charts, or whatever reason. And you can think of stocks that you probably have on your own mental list. I don't know what is on your list. On my list are stocks like Apple, and GoPro has been in some trouble lately, but it's still one I think is going to do well in the long run. Alibaba and Jazz Pharmaceuticals and so on. There are a number of them that are on my list. We want to own that stock, but we would like to own shares at a discount. And the way we do that is that we find a put. You're always going to start this cycle with a naked put, what's called a naked put. You're not buying the shares of stock at all. You're selling a put. It's called a naked put, but that's a bit of a misnomer because you're actually putting up a certain amount of cash to put on this position. There is a higher margin requirement for this position as opposed to the previous strategy, buying puts and calls. So you're going to have some money in your account set aside, enough money to actually buy the shares of the stock that you're selling the put on. Because there is a possibility in this strategy that you will have to buy the stock. So if you're buying, let's say, if you're selling one put on Apple stock and Apple's trading at 107, you would need to have $10,700 set aside in your account to put on this trade. You're not going to invest that money. That money stays as cash in your account, but it is tied up in what's called the margin requirement. So if you want to focus on lower price stocks, that's perfectly fine. Great strategy to use on low priced and high priced stocks. So you're going to sell an out of the money put, and we usually like to go maybe 10% or more below where the underlying is trading. and about 1 to 2 weeks out on the stock. So we want that expiration date to be no more than 2 weeks ahead of where we are right now in terms of the calendar. We want to see that theta decay, or that time value decay, rapidly increase as we hold on to that shorted put position. We expect our puts to expire worthless. That's what we're looking for. That's what we're hoping for. We're aiming at that. It doesn't always happen, but in most cases, I would say about 80 to 85% of the time, our puts expire worthless. We keep all the premium that we gained when we sold the put, and we go back and we sell another put. Because we're now 1 to 2 weeks ahead on the calendar, we're going to look at an expiration date even further out. But again, 1 to 2 weeks out from where we're at on the calendar, and we'll do the whole thing over again. If we're assigned the shares, and we're only going to be assigned the shares if the underlying closes below the strike price of the put that we sold. If we're assigned shares, it does happen. I'm in a position in GoPro right now because it happened to me last week. Then what we're going to do is we're going to sell another option on those shares that we now own, only we're not going to use a put this time, we're going to use a call. We're going to find an out-of-the-money call, and in most cases we're just going to go up 1 or 2 strikes. We're not going to go up too far on this, not as far as we went away from the underlying with the put. We're going to sell an out-of-the-money call on the shares. If we have 100 shares, we're going to sell one call. If we have 300 shares, we'll sell 3 calls. If those calls expire worthless, we go back and we repeat step 3 again. We keep selling calls on a strike price slightly higher than the underlying 1 or 2 weeks out to increase our premium that we credit to our account, or another way of putting it, it's decreasing our cost basis. We are making money on the shares that we own by, in effect, kind of taking a dividend from that stock. So as long as we continue to own shares, we will continue to write calls against them 1 to 2 weeks out. Sometimes we only get 25 cents, which would be $25 per call. Sometimes we can get a 150 or even 200. Depends on the volatility of the underlying. Depends on how expensive a stock it is, and so on. But then step 5 comes in. If those shares are called away, we go back to step 1 and we repeat. We sell another put, either on that company or on another company. And this is called the naked put covered call cycle. So I would say if you're putting on maybe 20 of these trades per year, 1 or 2 or 3 a month, then out of those 20, you can probably count on 4 or 5 of them getting all the way down to step 5. Most of them will only require you to do steps 1 and 2. So that's the naked put covered call cycle. I love this cycle. It's a great way to own some of your favorite stocks at a deep discount, and it just works. It works really well. You can actually go 50, 60, 70 trades on this cycle without ever taking a loss, because it just works that well. Now, there are times when sometimes you just have to break off the cycle altogether because your stock, for whatever reason, has just bottomed out. The fundamentals have changed, or the market has changed, or the market's crashing, or whatever. There's always those scenarios. But that happens once every few years if you're doing this the right way, and if you're in the right set of stocks. This is just a great way to produce decent income and to buy the shares of your favorite stocks at a deep discount. The last strategy, and what seems to be the most complex strategy because it requires you to actually trade 2 options at the same time, is the index credit spread strategy. And this is a strategy that I use quite frequently myself. It's best used when the markets are sharply overbought or oversold. That's not always the case, but if you're putting on a credit spread during a period of market consolidation, you have to take a few more steps into account, a few more things into account, and I'm not going to go into all those details here, but the easiest thing to do is to put on your credit spread when markets are overbought or oversold. This strategy carries the lowest level of risk and the lowest level of reward. You can go 20 or 30 trades in a row, and these are trades that only last about a week or 2. The naked put covered call cycle, that can take you several months to actually work out an entire trade if you get all the way down to step 5. But these are trades that are over and done with in about a week, and sometimes 2 weeks at the most. And so you're going to have a steady stream of small amounts of income coming into your account through this strategy. And you can go 20, 30 trades in a row without ever having to sweat about taking a loss or having to adjust the trade to minimize your loss. I'll talk about that in just a moment. Here's how these work. If the index that you're looking at, let's say it's the NASDAQ 100 or the Russell 2000, the S&P 500, those are the three that we primarily focus on, those three indexes. If the index is oversold, we're going to sell. We're always selling in this case. We're always going short the spread. We're going to sell a put spread, which is to say we're going to use 2 puts in our spread, in our trade. If the index is overbought, we're going to sell short a call spread, 2 calls. In either case, we will sell an out-of-the-money put, if it's a put spread, or an out-of-the-money call, if it's a call spread. And then we're going to go further out of the money and buy a put or call. Now, a put spread is always 2 puts. A call spread is always 2 calls. A put spread is always 1 short put and 1 long put. And a call spread is always 1 short call and 1 long call. A put spread is always, you're always shorting the out-of-the-money put that is nearest the underlying and buying the out-of-the-money put that's furthest away, and vice versa with a call spread. Typically, we like to use strikes that are 5 to 10 points away from each other. So, for example, I just put on a Russell 2000 put spread this morning, and I sold the 1110 put, and I bought the 1105 put. Both of those are well below the current level of the underlying, below the level of Russell 2000 by about 40 to 45, 50 points, something like that right now. Those are expiring in a week, 1 week. So I have 1 week with a 40 to 50 point cushion between where Russell 2000 is now trading and where my spread lies. And Russell 2000 has been in a pullback here, and it's right at support. So I don't expect it to drop another 40 to 50 points over the next week. It might. And if it does, we're going to have to do something about it, but I'll show that in just a moment. Credit is normally in the $30 to $100 range per spread. So this is not a lot of money, but considering we normally win on about 90% of our trades or more, and if we're trading, let's say, 10 spreads at a time, not everyone can do that. It just depends on the size of your account. You're looking at $300 to $1,000 per week, pure income, goes straight into your account. And as your account grows, of course, you can add more spreads. So you can see where this, over time, as you're accumulating the income, you can begin to trade 40, 50, 100, 200 spreads at a time, and people do that. And then, of course, you're looking at really big time money coming in on an income basis. For those 10% of trades that close in the money, which is to say, which is not where we want it to close. We always want the index to stay away from our spread. But if it closes either inside of our spread or below our spread in case of a put spread, or above our spread in case of a call spread, we're going to have to do something about it. We could just let it sit until expiration date. Our spread will expire at the prices that they're at in the money, and our account will be debited. But the fact that it is a spread means that our loss is capped. These are not trades on which you can lose an infinite amount of money. You are always losing a finite amount of money, and you'll know what that amount is up front. And the amount of maximum loss that you can achieve with these spread trades is defined by you. As you put your strike prices closer together, you will be risking less. As you move them further away from each other, you'll be risking more. But of course, risking more also means you can gain more on the reward side of things. There are ways, however, we can adjust that trade if we suspect it might end up in a loss of some kind. And there are all sorts of different techniques for adjustment. We can't go into all of those here. Sometimes if you have a put spread on, you can immediately then put on a call spread above the underlying, and that will minimize your losses. You can also add a third leg to the trade to minimize the loss. And you can even close one of the legs to minimize the loss. There are all sorts of things you can do. And I will, in the options letter, guide you in terms of that adjustment. I'm not going to leave you on your own. But it is sometimes we'll have to do that because the markets end up moving stronger, quicker than we expected them to. All right, so that's it on our Options 101, but we're now going to shift over to Trader's Workstation in Interactive Brokers and give you a little bit of a primer on how to actually buy and sell options. Back in a flash. Okay, welcome to the second part of this Options 101 webinar. I've taken you over now to my Interactive Brokers Trader's Workstation, which is the platform I use to put on options trades as well as stocks and forex and all kinds of other things. We're going to be focusing here on the three strategies that I use in the Dr. Stoxx Options Letter, the ones we just talked about in the webinar. And I'm going to show you how to put on each one of these strategies using this particular platform. Now, some of you will be using different platforms. You might be on TradeStation, or you might be using Options Monster or Schwab or Sure Trade or whatever, Scott Trade. I don't even know who's in business anymore these days. I've used IB ever since 1996, and once you get used to something, you just kind of stick with it. So I'm going to use this platform to show you how to trade options, how to get in and out of positions. But whatever you use, you'll have to tailor what I say here to adjust to that platform. Let's first talk about just buying an ordinary call or put. On my workstation here, I have the three major indexes, and these are the indexes we use for our credit spread trades. SPX, which is the S&P 500, NDX is the NASDAQ 100, and Root is the Russell 2000. You can see that it's kind of a down market day. Here we are in early December, and there's no Santa rally just yet. The markets have been pulling back to at least to a support area. Nothing major just yet in terms of a correction, but we are red today. I also have on here an ETF, the Gold Mining Index, GDX, and I have on here Apple. So we're going to use these indexes, stocks, and ETFs to show you how to put on a trade. Let's start with Apple, and let's say we're bullish Apple. It's trading at $110. I was using $107 in my example, sorry. It's a little bit higher than that now. And let's say we're still bullish on Apple. We think this sell-off today is a good buying opportunity. And so what we want to do is get our call options onto the screen. We do that by right-clicking on the Apple symbol, Trading Tools, Option Trader, and that brings up what's called the option chain. The option chain will show you a variety of strike prices for both calls and puts at different expiration dates. I can control which strike prices I see in the chain, which expiration dates I see, and so on. To control the strike prices, I use this drop-down menu, and right now I have highlighted strike prices 109 to 112. Apple's strike prices are priced a little strangely because Apple split its shares not too long ago. It did a 7-for-1 split, I think, or was it a 5-for-1? In any case, it was a split, and so the option prices that were trading at the time of the split had to, do some funny things with their pricing. They're not all at even numbers like they normally are. Whole numbers, I should say, as they normally are, although sometimes you'll get options priced in the 50-cent range. But here we have 109 to 112 highlighted. Let's just say that I don't really care about the 109.29 option or the 110.71 or the 111.43, but I'm looking at a couple of strikes above the underlying, which is at 110, and let's put 2 strikes below the underlying, and I'll click close, and then there are my strike prices showing up. Now let's also assume that I want something that's a little further out, because I want my call option to have some time to appreciate without losing much in the way of time value. The closer you are to expiration, the faster the time value slips out of your premium. So I'm going to delete these more recent expiration dates, the ones that are, one is today, December 12th, a week from now and 2 weeks from now. We don't want those. We don't want them in January either. I'm going to highlight the February, the March, and the April. Okay, so that gives me at least a couple of months of time, if not 4 months of time. Now, here's something interesting, because when I clicked those expiration dates, February, March, and April, I only show the 110 call option. I wanted the 108, 109, 111, and 112, but what this spread is showing me is that those options are not trading at this point. We have to get closer to those expiration dates for those options that are in between the major numbers, 110, 115, 120, and so on, to begin to trade, and they're not trading just yet. So what I can do now to give me a few more options, I can erase the 108, 109, 111, 112, and let's put on the 105 and go down and put on the 115. And that way I have 3 strike prices per expiration date. You can see 3 for February, 3 for March, and here are the 3 for April. So then I look over to see, I'm just interested in the calls, I look over to see how these are trading and what sort of premium I have to pay for each one. Remember, the 110 is at the money, 105 is in the money, and 115 is out of the money. And you can know that immediately because the 105 and 110 are listed as green, and the 115 is listed as red. For the puts, it's just the opposite. The 115 is in the money, the 110, the 105 are out of the money, so they're red. We're not interested in the puts right now. We're thinking Apple is going to go up, so we want to look at the calls. Now, if I want to buy an at-the-money call that's going to expire February 20th, I have to pay $625. It's listed at $625. Multiply that by 100, $625. Let's say that's the one I want. I think it's going to go up well before February, and that's far enough out, and so I won't have to lose too much in the way of time value. So I'm just going to highlight this one and drag it over to my screen, and there it's going to show up on my workstation. Now I can also trade straight from this dialog box right here by simply double-clicking on the 620, and I can now see, it's not giving me much room here, but you can see that I have in here the bid and the ask, the buy one call at a limit price of 620. It automatically puts my limit price right between the bid and the ask. I've set it to do that. And if I just hit this T, this blue T button right here, I'm in the trade. At least my limit order goes out at 620, and market makers will probably fill it on something like Apple, that's very heavily traded. But let's get rid of this dialog box and go straight to the trader workstation itself. Here is Apple 2015, the second month, February, the 20th of February, C for call, at a strike price of 110. Those numbers will become second nature to you once you see a bunch of those. And it's trading at a bid of 615 and a ask of 625. If I want to buy one call, which I do, I click on the ask. I'm going to lower my limit order to 620 because I'm going to try to trade between the bid and the ask, and I always recommend doing that. It saves you a little bit of money, and it does ensure that there's a market, a good market for this trade. If I wanted to buy that right now, which I don't really want to right now, I would just click that transmit button. To get it off my screen, I simply discard it. Now, if I wanted to sell a call option, which I really don't want to do, I would just click the 615 and I would be selling that call option at 6.15. And again, I could change that. I can even go in the pennies now at a midpoint of 6.18 between the bid and the ask, but definitely don't want to do that. Okay, so that's how you would buy or sell a call option. Put option is exactly the same thing, only you're looking at the right side of your chain, your option chain, and not the left side. Now, let's say we wanted to sell a naked put on Apple. We like Apple as a modestly bullish move going forward, and this time I'm going to get my put up on the screen in a slightly different way. I'm going to type in Apple, and instead of putting the stock on my workstation, which is already there, I'm going to go under Options. And you use this in case you already know what month and week and strike price you want to trade at, and I would pretty much know for Apple. Because we're now in early December, I want to look at a strike price that's about 2 weeks away, so I'm going to stay in December, and I'm going to be selling a put. It's trading at 110. I'm going to go lower than that. Let's say 106. And I need a strike price that's going to expire in 2 weeks, and that would be the 26th, the day after Christmas. And I'm going to use just the smart order routing. I click OK, and there is my strike the 14th, that's 2014, December 26th, put option at a strike price of 106. I can sell this by clicking on the bid. That bid ask spread is very close because this is a near-term option. The spread is very close. I'm not going to worry about getting between the spread, and sometimes you can't even get between the spread. But I can sell this for $95, and that means this put option is going to place $95 of cash straight into my account. I will be short one put of Apple. That put will expire worthless in 2 weeks as long as Apple continues to trade above $106 per share. Now, if you are bullish on Apple, that's a no-brainer, right? That's about 4% away from the current price of the underlying. And a 4% move on a bullish stock downward, especially this time of year, right? Seasonality, we were thinking Santa rally in a couple of weeks. Apple stock should do okay. So that's almost a no-brainer kind of short. You're going to make that $95 and it goes straight into your account. If, however, Apple falls below 106, that's our strike price, on the date of expiration, the 26th of December, we will be forced into buying shares of Apple. And we'll have to buy shares at the strike price, 106. Now, we already have that now it's $91 in our account. That stays in our account no matter what, unless we buy back the option. But if we hold it to expiration, it stays in our account no matter what. So our actual cost basis on those Apple shares that we're forced to buy because Apple closed below 106 2 weeks from now is only 105.09 cents. So we're now in 100 shares of Apple at a price of 105.09 cents. As long as Apple trades above that, we make money. What we then do, we turn around and we sell a covered call on those shares of Apple that we own, maybe 2 weeks out again. We might get about at $90 for that covered call. That lowers our cost basis down to 104.19. So that's how you work the naked put covered call cycle. Here's Apple trading at 110 today. I'm putting on a position that could potentially get me into Apple at around $105 a share. That's a pretty good deal, and that's only 4 weeks out. So 4 weeks of holding time on two option trades, reduces my cost basis on Apple down to 105. Now, I may not end up with shares of Apple, and in most cases I won't. But if I do, I'm still good because I know I like the stock, I'm bullish on the stock, and I don't mind holding shares at a good 5% discount to the current market. Now, the third type of trade that we put on in the Dr. Stoxx Options Letter is the credit spread, what I'm going to call the vertical credit spread. There are diagonal credit spreads. We're not going to worry about those. There are calendar spreads. We're not going to worry about those. I focus on the vertical credit spread. The vertical credit spread keeps both legs of the spread, both puts or both calls, at the same expiration date. Just makes things a little simpler for me at least, and I like to keep things as simple as possible. So we're going to put on a credit spread on the Russell 2000. I actually have a credit spread on this index right now, and so it's easy for me to replicate that. We note first of all that the Russell 2000 is trading at the underlying is trading at 1159, it's almost 1160. And I know from looking at the chart that there is some support in the 1130 area and in the 1120 area, and there's certainly support at the 1100 area. So it's in those lower areas that I want to put a credit spread. I'm going to be using a put credit spread, which means I'm modestly bullish. And I'm modestly bullish the Russell 2000 from here because it has traded down. It's a bit oversold, and it's trading at a place of price support. It's not really strong price support, but it is price support. So I suspect that for at least a few days, it's going to get kind of caught up in this area while it forms maybe a little bit of a base. It might bounce, it might trade down, it might go sideways, but I don't think it's going to go down nearly as far as the put spread that I'm going to employ here. Now, to put on a put spread, there are different ways you can construct the spread using the trading workstation of IB. We'll do it the hardest way so that any other way is going to seem really simple to you. You want to right click on the symbol, go to trading tools, and pull up your option trader. And then you'll notice an option here called Spread Builder. Click on Spread Builder, and this pulls up a little bit of a space here where you're going to build the two legs of your spread. Now remember, we're putting on a put spread, so both of our legs will be puts. Both of our expiration dates will be the same, but our strike prices will be different. Remember, the Russell 2000 is trading somewhere around 1160. Support is down around 1120 to 1100. Let's split the difference there and say 1110 is where I want to put the higher end of my put spread. And I don't want to go too far out. I want to go maybe a week, maybe 2 weeks. We'll see what kind of a premium we can get with 2 weeks. Now, we are always selling put spreads. We're always selling call spreads. So whenever I'm putting on a credit spread, we're always selling them. So you're going to always select sell rather than buy. I won't explain what happens when you select buy, but it's a whole different kind of scenario. So we're going to sell our credit spread. We'll leave this here at 1. We're only going to sell one credit spread at a time, and we can change that at the order entry if we want to, but we're just going to leave it at 1 for now. We're going to choose our expiration date. Now, we're already at December 12th. The Russell 2000 is not actually trading. I mean, it is trading today, but you can't trade options on it today. It expires at Friday's open, and here we are in the middle of Friday. We could go 1 week out, but to get the most bang for our buck, I'm going to go 2 weeks out. It's a period that is seasonally very bullish. All kinds of reasons why I don't think the Russell 2000 is going to tank over the next 2 weeks. So we're going to select that date. The strike price, now remember 1110 is where I thought we should put our higher leg. So we'll put that at 1110. Kind of hard to see these numbers. There it is. And the type of this is a put. Multiplier, just leave that at 100. The trading class is always RUT, and we're good to go. That's leg number 1. Leg number 2 is a buy. We're going to be buying a put. Same expiration date, December 24th. Let's widen this out a little bit here. Strike price now is different, and we want to buy the further out strike price. So we need to go below 1110. We could go, let's get up to the 1100s here. Our only option is 1100. So we're going to go 1100. That's a 10-point spread between the sold put and the bought put. That 10-point spread means that we are risking, minus the credit that we get, we are risking $1,000 for every credit spread that we put on. Now, some of you may not want to take on that much risk. So you would need to look for strike prices that are only 5 points apart. In your case, you would probably put on the 11.20 and the 11.15. So you would sell the 11.20 and you would buy the 11.15. But let's say that you are okay with $1,000 maximum risk. And again, you're also going to get some premium, so not all of that is being put at risk. Our second leg is a put, of course. Leave the multiplier, leave the trading class as is, and then you are good to go. This is a bullish put credit vertical spread that we're putting on. And it's going to tell me that I can get a credit of 90 cents, which is the translation, that's $90. So I can attain a credit of $90 per spread. If I put on, let's say, 3 spreads, I am risking $3,000 now, but I can make a maximum gain of $270. It's not updating that for me, but that's what it would be. So that's how these work. And then to get into the trade, I would simply click the transmit button and then I would be in. So that's it. If you have any questions, feel free to email me, Dr. Stoxx at drstoxx.com. I do hope you enjoy the Dr. Stoxx Options Letter. If you have any questions on that or any of the things that I post on the blog at marketfi.com, simply email me through that site or through my site, drstoxx.com. God bless everybody. Happy trading. Bye now.